You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Joining me today on Profiles and Perspectives is John Burnside of Freeboard Capital. Hello, John. How are you?
I'm doing very well, Joe. Thanks for having me.
Well, thanks for joining us. And if you would, tell us a little bit about your background and your experiences in the industry.
Mainly my background, Joe, has been in the options industry. I've traded equity options since 1986. So I got to see the 87 crash, the mini crash of 89. I got to
Lucky
see
you.
The internet. Oh, yeah, that was a lot of fun. In 87, during that crash, I was one of the three guys left in the pit that didn't get tapped on the shoulder. And I was so young that I didn't even realize what I was up against at that point. So, but that being said, I also got to see the internet boom and bust. I got to see everything go from eighths and quarters to nickels and dimes to pennies. I got to see multi-listed options on many different exchanges, and now we're up to 12 or 13 different exchanges that trade listed options. And I've had a little bit of experience in the commodities world as well. I traded during the drought of 89. I traded some corn and soybeans over at the Board of Trade. Kind of a diverse background, but predominantly it's been in the equities, not too much in the indices or the futures, but a lot of time in the equities.
Well, you hit on a lot of the key, really important parts, or important segments of history in the industry over those last 25 or 30 years. I had the good fortune I think it's good fortune to experience all of that myself. And so you've evolved over to Freeboard Capital. Tell us about Freeboard and what you do over there.
Freeboard, what we do over at Freeboard is we help many people don't have the insights that shall I say, an experienced trader does in regards to helping people reduce risk while still keeping their positions intact. And especially after what went on in 2008 and 2009, everybody at this point in time seems to be looking over their shoulder saying, how can I keep what I have and give me some upside potential as well? And so we're doing a lot of consulting with registered investment advisors and as such that need a little help and giving their clients some advice regarding how they can better insure perhaps their largest asset now, since the market's gone up as much as it has lately.
Well, it's interesting. You talk about managing risk, and there's no more important aspect of, managing finances. It really seems like a perfect segue right into the options product and space. How do you use options in your business?
Well, there's several different ways. I kind of relate it to, hey, everybody's got insurance on their house or their health or their life, but a lot of people don't realize that you can insure that asset. And the way that we've been communicating with these different registered investment advisors has been through the capability of as simple as putting on a collar, which is buying a put and selling a call to finance that purchase. And it does limit your upside, but at the same time, a lot of people are very leery of what's going on in the economy. And, the market's gone up for 4 or 5 years in a row now, and they don't want to give back what they've gotten, what they've made. And people do not want to be in that spot again where they have an issue like they did in 08 and 09. A very simple strategy.
I was just going to say, let me touch upon that collar strategy. You described it as buying a put and selling a call to finance the purchase of that put. Now, that's with the assumption that you're long and underlying, correct?
That is correct, yes. So let's take a simple scenario. Let's say you own XYZ stock, and it's trading at $50 a share. And you can put, it's not like you have to be super conservative, but you just don't want to have that catastrophic event that puts you in a bind, that gives you some angst at night, shall I say. It gives you the ability to sleep very well.
Well,
and what we do is, depending on and each registered investment advisor's clients have different risk tolerance. You know that.
Mm-hmm. So let's for our listeners, we've got this $50 stock, and we've got different, as you say, risk tolerances. So how, in terms of specific strike prices, may you go about, putting on a collar around this $50 number?
Well, there's, that is a very great point, Joe. Anymore, there's so many different alternatives. Many of the stocks that trade below $50 have dollar strikes. If it goes above $50, then the strikes become $2.50. And then once they're over 100, they can even trade in in $5 increments. So in this case, let's just say that we want to have a fairly tight collar on, and we want to be able to sleep really well and make sure that we keep what we've made so far in this market run up. So in this case, we might buy a 45 put or a 46 put because it's got dollar strikes,
right,
and sell a 52.5 call to finance that purchase. So you would have, as somebody that I've talked to about this, is you would have bumpers, almost like you have a bowling alley, right? And when you used to be a little kid and you wanted to put the bumpers in the bowling alley so you couldn't get a gutter ball?
Absolutely.
The bumpers are in place, and now you have the bumpers in place. Your bottom side is 46, your top side's 52.5, and all of a sudden you're sleeping real well, or you're taking a bike ride with your wife, or whatever the case may be. And everybody else is sitting there going, man, what if it goes to 40? What if it goes to 30? And you're like, it doesn't matter to me. I'm out at 46 if it did something stupid like that. You never know what's going to happen.
This is true. And that's now, I think you work with, some RIAs and clients where there are some concentrated stock positions, but you don't need a concentrated stock position to employ a collar, right? I mean, you get a run up on a stock.
No.
Okay.
Yeah, you're exactly right, Joe. I mean, it can be. Remember, though, Joe, and this is for every, whether it's retail, registered investment advisor, or anybody, each option, and this is kind of confusing, each option contract is worth 100 shares of stock. So if you have 500 shares of stock, you don't want to be doing 500. You don't want to be making a trade of 500 options. It's only a 5 lot of options. So a lot of people get confused on that. They're like, well, that doesn't make any sense. And it's just the way the options contract was written way back when they were initiated. And it's just one of those givens in the way that the world works. But a lot of people have gotten themselves into trouble of, hey, I've got 500 shares. I bought 500 puts and I sold 500 calls. And it's like, whoa. That's not good. If you have 500 shares of XYZ company, you want to do a 5 lot of puts and you want to buy a 5 lot of puts and sell a 5 lot of calls. It's not one for one.
Amen to that. Thanks for that reminder. That is, that's definitely part of the ABCs of options. Now, are there any other strategies, John, that, you employ?
Well, what I've done with some of the RIAs is I've suggested, I said, let's look at where the risk is. And many of these companies, whether they're high tech or whatever the case may be, but let's use an example of XY Tech in this case, and they think that there's some upside potential, but they still want to collar it. They want to have an insurance policy that they're not going to get beat deep, right? But they'd love to participate if there's a big move, if there's a moonshot type move on the upside. Well, we have educated these registered investment advisors to employ a spread that we refer to in the trading world as a back spread.
Back
and
spread.
What a back spread.
Yeah, the good old back spread.
Well, you probably have heard of it, Joe. The old back spread. That's right.
Sure.
So what a back spread does is it will sell, and I'll give you a very simple one. It will sell one contract and buy 2 of the out of the money contracts. And this is very simple, and what happens is if the stock moves a significant amount, the one contract is negated by one of the longs, and yet the other one just continues to appreciate in value, so you end up making a lot of money. And the great thing about this is that you can dial it up, dial it down to whatever your risk tolerance is. But in the meantime, you have extra capability if it does do a moonshot that you're going to be making perhaps even more money than you would have with your original position.
Gotcha.
With taking less risk.
And when you say dial it up depending on your risk, that means you can maybe get into a ratio greater than 2 to 1. Is that what you meant?
Exactly. You can get bigger than yes, you can get bigger than 2 to 1. And the premise is if it does nothing, then hopefully you're not out too much money or any money at all even. But if it does go up significantly, like 100%, you will participate on that, not the whole 100%, but towards the end, you could be doing real well.
And if memory serves me, I guess, the one thing that you fight, now depending, as you said, on the ratio, you may do it for even money, you may do it for a debit. If you get into some crazy 4 to 1 ratio, maybe it's a fairly significant debit, but you don't want that stock to be at your short strike at expiration if you've got a debit. Is that correct?
That's right, because then you'd be out the money.
Okay.
So
all right.
The goal is to try to keep your cost to a minimum while giving yourself more upside potential.
I love it. Can you do that on the put side as well?
Absolutely. And some people have been asking about that, to do it on the put side now that the market's gone up like this. And obviously, and with your experience, Joe, you know this, the puts are always more expensive than the out-of-the-money call. The out-of-the-money puts are always more expensive than the out-of-the-money calls. So it gets a little tricky, and you may want to ask somebody that's been doing it for a while to get some professional advice. But for the most part, it is available. You just got to know what you're doing and be careful, because I don't know how much your audience knows about skew. Have you ever discussed skew regarding how the puts are always have a higher value than the out of the money calls, but it can become tricky with the put side. But the concept is still the same.
Well, that's excellent, John. I think for our listeners who are new to the option space, maybe this is their first introduction to both collars and back spreads. For those who are, pretty well into the space, maybe it's a good review. So appreciate that a lot. It sounds like you're offering some great expertise over there at Freeboard. As we wrap up, you got any words of wisdom for our listeners, or maybe a funny story from the floor?
Well, yeah, I always love this one story. So I was working on the floor, and we always guys would take lunch at different times, and there was a little deli that was across the street from the SIBO, and they had great sandwiches, but they always gave a pickle for their sack lunch. So guys would basically grab a sandwich, eat it on the way back to the floor, but they'd have this pickle left. And one guy ended up dropping the pickle in another guy's trading jacket. Now, the pickle was in a baggie, so it wasn't like it was exposed. But somehow the guy popped the bag, and he ended up with pickle juice all over his trading jacket, all over all of his trading cards. And he was not happy when he got back to the pit, and he wanted me to do something about it. And it was really pretty funny. He's like, "I got pickle juice all over me, and you need to do something about it." And I'm like, "I can't do anything about getting pickle juice on you." I mean, it was just so funny and ironic from this little incident of trying to go get a sandwich quickly to it blows up to a pickle juice issue. I still laugh about that one. It cracks me up to this day, and that was 10, 12 years ago. So I can vividly remember it.
Those stories from the floor are few and far between anymore, as the floors have turned into a different environment. But thanks for that.
Yeah, no problem, Joe. And I look, if I can help you out anymore, let me know. And it's been a great time. And thank you again for having me on your show.
My pleasure, John. Thanks for joining us today.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, especially for you first-time listeners, we're going to be sure you know about our own website, www.optionseducation.org. That's the OIC site. You'll find all kinds of great options education there in many different formats. And please remember, too, our exchange partners have excellent websites as well. Now, a resource I'd like you to consider is bigcharts.com. I use it all the time. Now, if you try it, be sure to use the advanced and interactive chart links to allow you to get more information and wider date ranges on your charts. Finally, today's good read is Dan Passarelli's The Market Taker Edge. As a longtime SIBO floor trader, Dan offers his trading wisdom in this excellent read. Check it out. That does it for today's tools, resources, and good reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, we're going to take a quick look at the NASDAQ index. The symbol's COMP, C-O-M-P. We're going to take a look at this over the last 15 years. And I'll tell you, it's been quite a ride. Let's start in the late 90s. Many of you may recall this period is now referred to as the dot-com or tech bubble. In raw numbers, the NASDAQ index rallied from about 1,500 in late 1998 to just over 5,000. Yes, 5,000 in late 2000. At the time, no price or PE ratio seemed too high for many NASDAQ stocks, especially the internet startups. Significant gap openings to the upside were common, and CNBC couldn't get enough of it. Volatility was king. Long option positions also ruled the day, even with theta levels super high, but that was justified because these NASDAQ stocks were flying all over the place. Eventually, the buyers exhausted themselves, which happens in boom-bust cycles. Over the next 2+ years, the NASDAQ retreated almost 80%, from 5,000 to just over 1,000 in the fourth quarter of 2002, a true boom-bust cycle. Now, from 2002 to the end of 2007, that 5-year period, the index rallied back close to 3,000. Then, of course, the financial crisis hit, and back down to about 15,000 is where the NASDAQ index retreated to. Now, the reason I wanted to review our NASDAQ history today in looking back is because here we are close to 15 years after the 5,000 top, and we're more than 10% below that all-time high level, while the S&P and the Dow continue to make new all-time highs. The one message here is to know the market you are trading, know what drives it, and know that it can trade quite differently from other broad market indices. That's it for today's Looking Back.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.